When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio and the ever squirrely X Spaces. This is John Galt speaking. Welcome, one and all, to what has been one of the most bizarre, wild weeks that we've seen in markets, politics, and the underlying economy, which you're really not hearing a lot about. You're just hearing the song playing over and over again. Happy days are here again. I will say up front, I am still bearish, not for the reasons you might think, but because there's some underlying rot that has nothing to do with Donald Trump. Donald Trump is about to inherit a nightmare, and I feel bad for him because the media, in their usual leftist stupidity, and the sheep are all going to buy, hey, guess what? It's his fault. If you look at what's happened since last Friday when we first gathered here, the Dow, which closed last Friday at 42,052, is closing today at 43,988. The S&P 500, which closed at 5728, kissed and got above 6,000 briefly, closed the day at 5728 last week, 5995 this week. The NASDAQ, 18,239 last Friday, 19,286 this week. Huge numbers, big moves, unbelievable volatility in the markets. We peaked on the MOVE index, which if you don't follow it and don't follow the writings on macroedge.net, made a major move to 136 for the high for the year. It's a bizarre situation in treasuries where we got almost to 5% on 4.5% on the 10-year yield, and it looked like it was going to make that move, then pulled back as buying entered into the market during the week. Meanwhile, in gold and silver land, gold finished last Friday when we spoke at 27.38. It's at 26.92. Not a massive correction. Silver, which finished last week at 32.55, down to 31.38 for the week. The big moves were in the oil markets, a big rally, and then all of a sudden everyone realized that with Trump coming to office, he's going to drill, baby, drill. Crude, WTI finishing at 70.42, Brent at 73.96. Dr. Copper briefly verified the rally in gold and silver. Profits have been taken since, and it has become a fascinating thing to watch as everyone has piled into the popular bullish trades. This market went vertical. I don't know what's going to happen in the next 60 days. I do have a good idea of what's going to happen next year. Hopefully we can get some of our experts to comment on this, including Six. I don't know if Mr. Awesome's around. I've invited several people to give their quick take on the post-mortem of the election and get their opinion, because I'm seeing some other things that are happening. I think too many people got too bullish too fast off of the results. One of the people that I do respect, Craig Fuller over at FreightWaves, has pinned a piece today. The Great Freight Recession is officially over. I don't want to dissect it on air, but I will dissect it in my writings this weekend. I'm going to just counter it with one indicator that this is probably premature, but we'll get into it more in depth, and I'll get some numbers to back my theory up. From lmglobebest.com, logistics real estate faces mini cycle of subdued demand, November 7th by Kristen Smithberg. And the reason that I bring that up, absorption rate for on incoming new logistics warehouse space, etc., totaled 40 million square feet during the third quarter, down 34% from typical levels, according to the report. We're not seeing major demand, and we've also seen Amazon abandon a lot of their expansion plans. And with companies like American Freight and others going under, there's not going to be as large of a demand for logistics warehousing space. There's going to be major issues with regards to existing space. Price pressure should and probably will continue quite heavily heading into 2025. I think what Donald Trump has to do is get through the first cyclical recession in Q1, Q2. The NBER is going to have to recognize that we've been in a recession of some sort, possibly since last April, as Amy Nixon and others have said. I tend to lean towards May, but that's just a matter of days, not anything major. The other thing we have to look at, what is going on with credit? And this is where I'm going to start bringing my guys into this. It's unfortunate. We're going to see a new phrase that pays. While everyone is bathing in the overkill, shall we say, of the election, and that's a lot of information to digest. I mean, we have people yelling at each other on television. We have people screaming into their cell phones to make selfie videos. We have some people who have engaged in some rather dicey speculation on what the future will be. I don't want to break it to anybody. I don't think the status quo is going to change dramatically in the next 60 days to 90 days. That's just reality. The current president, Jill Biden, has the power to initiate massive spending, massive aid to Ukraine, massive open border policies, and a lot of different items which are going to complicate Donald Trump's entry into the White House. I wrote about that last week. I stand by that statement. They are going to do everything they can to sabotage him, a lot more than removing letters on a keyboard like the Clintonians did when W got in, and a lot more than mischievous things like rearranging the china or stealing all the forks or whatever. We're going to see a bigger change, a sea change, so to speak, in what's happening with the economy, number one of which will probably be a discovery in February of 2025 of what the quote-unquote adjusted seasonal real numbers were upon further analysis. That's where they're going to sit there and hammer Donald Trump and try to impair his first 100 days. People, pay attention to what's happening. Pay attention to a lot of the numbers that you can get at macroedge.net. Charles Payne was nice enough to give kudos to MacroEdge on the X platform, and also listening to Deborah DiMartino Booth on Fox Business Today mentioning the data. It's good enough for those people to pay attention to, and they like the quality of the data. Take advantage of subscribe, please. Subscribe to macroedge.net, free 2-week trial for Ozone. It will help you make a more rational decision about your investing future and the economic outlook. This team has put together one hell of a product, and I think it's worthy of pushing every chance we get. So what is the big issue I see heading into 2025? Well, if we take a real basic look, the Financial Times dropped a story yesterday. It was basically ignored by FinTwit because it was like, look at the shiny object, the Dow and the S&P and the NASDAQ. Rising redefaults in commercial real estate loans raise alarms. How bad is it? Well, what is a redefault? First, we're actually witnessing banks redefault on modified commercial loans. Data shows that redefaults on modified commercial loans are up 90% from last year, reaching $5.5 billion by September, the highest since 2014. Everybody feeling warm and fuzzy now? Redefaults are happening. Defaults have been mostly seen in office space, retail centers, and apartment buildings, all hit harder by higher interest rates and decreased occupancy since the pandemic. The bigger picture, as they say, from the takeaway, as CRE today likes to refer to it, as 26 billion in delinquent commercial property loans stack up, a 25% jump this year, banks' reliance on extended pretend strategies may be reaching a breaking point. So what is extended pretend? Well, it's exactly what it sounds like. Payments.tv, payments.com, PYMNTS, if you're not following it, I call it that just for short. They talk about the kicking can down the road on commercial property loans and how dangerous this is becoming. And if they keep kicking it down the road and there's no relief, they're kicking it down the road because they're assuming that rates will come down. They haven't been coming down. They've been steady. They've been hanging around. They've been harassing everyone who's trying to refinance and causing the extended pretend. Hey, can we extend this out 90 days until we see a decline in rates? I'm in the camp of Jim Bianco, who made a great appearance on Bloomberg this morning. If you haven't seen it, you can get it for free. Bloomberg had replays, surveillance in the morning. He was on at the 8 o'clock hour. I highly recommend you listen to what he says. He wouldn't say the S word. He basically said he's a no-lander. I'm a multi-bumpy crash and land burn person. I think we're going to go through a stagflationary cycle next year through no fault of the elected president, through the fault of our Federal Reserve chairman, who's going to go down in history as one of the biggest blunderers in the last 60 years. He is following the exact same patterns of Arthur Burns and Paul Volcker by engaging in this crazy rate cut in September instead of doing it earlier and easing the system through it 3 quarters ago. All of these rate cuts are going to hit in the middle of next year. And that's going to spark another inflationary cycle. We already see evidence of that in food prices. International food prices are stubbornly high today. Nothing to do with our grains, nothing to do with our exports, everything to do with a stronger dollar exporting inflation indirectly overseas to these countries because their currencies can't handle buying our product with a strong dollar. In fact, the dollar is so strong, a little footnote from the news this week you haven't heard about, the Saudi Arabians are issuing dollar bonds for the first time in years. So much for the collapse of the petrodollar, as many beat their chest and pronounced on the internet. We saw it on FinTwit. We saw it in articles and bloggers everywhere. The petrodollar is not going anywhere in the short term. And with Donald Trump in office, it's highly unlikely, no matter how much he would like a weaker dollar, we will see a weaker dollar. Stagflationary cycles are nasty and how they attack people's livelihoods. You look at what occurred in the last major stagflationary cycle America experienced in the 70s. It was not pretty. You would look like things were improving, then inflation would take over, leading to another recessionary cycle. We will see 1, 2, 3-quarter recessions flanked by 5-6% inflation. That'll look like growth, but it will mask the underlying rot that is occurring to assets and personal earnings and income underneath. This stagflationary cycle is going to be no different in this broadcaster's opinion. Anybody who wishes to come on and discuss this, please just request to speak. I'll be more than happy to put you on, because if we go through this stagflationary cycle, the refinancing prospects for the commercial real estate industry and for residential real estate is not going to be good. Commercial real estate, double defaults are up. Now, if you can't, for the extended pretend crowd, if you can't modify those loans again in 1 or 2 quarters because rates are higher than when you first pretended and extended, you're going to have a major crisis. And we're going to see a lot of paper hitting the markets, along with a lot of real estate hitting the markets in default. Bear with me, folks. It's after 4 o'clock, and sometimes you have to wet your whistle when you talk as much as I do. So we see what's coming. We see the outlook. I haven't changed my bearish outlook only because I think for the next year we will be in a stagflationary environment. And everybody is invited to speak on this. I am more than happy to defend my position on that. I am more than happy to sit there and take warnings on that. Kenny is probably going to join us in a few minutes. I'm hoping Ulysses is out there somewhere, and I'm hoping our friend Six can comment on the markets. Anybody who wants to pipe in and join on that, because what we're starting to see with the residential real estate markets is an impact from 7% plus mortgages. That is going to have a very, very unhappy ending. And that is where I think the real problems are about to come in. Six, good afternoon, sir.
Hey, John, how you doing?
Pretty good. What do you make of the markets this week? Is it euphoria? Is it short term?
Yeah,
is it long term? Or is it just insane?
That's euphoria. I think it probably keeps going up, to be honest. I think we're going to end up going higher. This looks like, to me, what is either the beginning or maybe the end of a blow off top, but I do think we're gonna go higher, at least into January. I don't think that this is going to end until we start seeing some disappointing economic data, like some upticks in U3 unemployment or the very disappointing GDP report. But I feel like it's going to take one of the major economic releases to be far below expectations before this calms down. Because
I agree with you.
Yeah.
1,000%. I think that retail sales in December is going to be one of the big markers. And I also think that the underlying rot in the financials, even though they have promise of less regulatory oversight, they still have to report what's happening in this current quarter and the next quarter. I think defaults are going to tick up and start to hit the bottom line.
Yeah. I mean, you're already seeing that in CRE. I was looking at a lot of charts today. You have credit originations are still rising, but they're decelerating substantially. Just a lot of markers of late cycle slowing, but as it pertains to valuations, they are very hungry for risk right now.
Do you think that the bond market is still correct? And what do you make of Bianco's observation of a no landing, where I say a stagflationary landing? Just throwing that out there in the open, even if you haven't listened to him. A lot of people are in the no landing zone. Is going to be status quo, but I have a fear that they're underestimating and underreporting the actual consumer inflation, and that is where it's going to start rotting away at the edges and fringes of the market, in my opinion.
Yeah, I mean, I don't necessarily agree with the CPI either. You look at the median housing price, you look at the price of every time I go grocery shopping. I mean, oil hasn't moved a whole ton if you if you just smooth out the data for when crude futures went negative for a while. If you just smooth it to the trend, the oil's not crazy. But the general basket of goods that I buy is certainly not up by the amount that the CPI claims it is. But I don't know. The other thing to reckon with for the bond market, I think, is going to be if the economic data, independent of the inflation data, does continue to cool, you're going to have a more rapidly cutting Fed, but then you're also going to have QT being either slowed or otherwise eliminated, and that's going to have impacts on the bond market, big ones. So I'm pretty confused on rates right now. I don't have a very good viewpoint on rates right now. I do think that when tens got near 4.5 again, I wanted to buy them, and they've since come down. But when I hear Druckenmiller talking about tens could go to 5.5, 6, it makes me nervous.
I 100% agree. I think the 418 neighborhood is going to be the floor, and that we'll start seeing it creep up faster and faster. We'll get a pause during the Thanksgiving holiday as everybody bugs out of town. And then I think the financial question, similar to what we saw in 2018 with the financial system, the banks, starts to creep into the bond market again. I think we're going to see some pretty heavy selling in bonds heading into year end, along with some equities to take their profits. Everyone makes a joke about year end selling, but you're involved. You've seen it. It happens. Tax selling is part of the cycle. We could have a Santa Claus rally and a major sell-off by institutions at the same time.
Right. And if we do get up to 5% on the 10-year, that is a level where I would very aggressively be buying bonds and very aggressively be shorting stocks myself.
I think you've got a great strategy there, folks. And folks, if you want to follow along, Six has a fantastic program over at MacroEdge.net. Why don't you fill everybody in real quick?
So we have our MacroEdge Vision investment desk. We run a portfolio of investments across all all asset classes. Really just trying to have uncorrelated returns to the S&P. We go after total return seeking. It's not benchmarked to the SPX, but yeah. Had another idea today, John. If you want to talk about it, I'm thinking short the euro against the Russian ruble, and I'll explain what I'm thinking about. I'm thinking, Trump is talking very heavily about how he wants to go in and end the war in Russia and Ukraine, and I think that the market is underpricing the Trump's ability to actually do that. I do think that is something that he can heavily influence, especially if he He leans on Putin, and especially if he threatens Ukraine with, ceasing to supply them with weapons. I do think that he has, more power than the market's pricing there. But then also, if the war is ended with Russia and the sanctions are removed, that'll leave room for the Russian economy to grow. That will, maybe get them listed on U.S. stock exchanges again. Just a whole litany of items. You have Russia that is monetarily tightening. They just raised rates in October. You have the ECB, which is aggressively easing. Germany is falling into recession. Their economy is not doing well. I mean, you have all the factors there, in my opinion, to boost the ruble against the euro. What do you think?
I'll bounce this off you again. I would delay that move because today I'm sure you haven't seen the news because I follow you. Well, you know what a geek I am. The Biden administration quietly signed an executive order authorizing American PMCs, private military contractors, to go to work in Ukraine.
Yeah, maybe wait for inauguration on that one then.
Yeah, because if there's anything that Biden can do to sabotage Trump, they will do it, and that's only going to enhance the conflict heading into winter, which is pretty scary. However, coming next summer, when I think the U.S. dollar is going to face some weakness as the interest rate cuts impact our economy and our markets. And everyone thinks, well, he cut interest rates, that's it. No, it takes 9 to 12 months to impact our markets and our economy. I think that's when we'll start seeing it. And I think that's when the inflationary cycle kicks up again. So it might be an excellent play because the euro has only one direction to go. And the whole continent looks like it's falling into a major recession.
Yeah, the European economy looks pretty poor right now. Looks pretty darn poor.
Well, I'm just waiting on Italy to announce they're going back to the lira because of the weakness in the euro. That would be entertaining.
That would be quite entertaining.
Six, thank you so much for your input today, and thank you for your take. Folks, you can read more from Six on MacroEdge.net. Ozone, 2-week free subscription. Don't forget it. Kenny, welcome aboard MacroEdge this Friday, November 8th. Has there been enough insanity this week, and have all the crazy redneck girls gone topless on Broadway?
Oh my gosh, good Lord. That's ridiculous. Well,
I figured everybody celebrates in their own way, and that's what I've noticed about Nashville. They have their own way of celebrating. That's for damn sure.
Well, it's certainly a free-for-all down here. That's for sure. Yeah, I mean, people, look, here's what I would say. People just around here in general, they think that, especially as it relates to real estate, that prices just can't go down. And, you can pretty much get away with whatever you want on that front, and you're going to be successful. And the reality is that's just not how that works. And the cycle does still exist. It's just delayed, and there's a lot of hand-holding right now. So it's kind of a weird sort of dystopian backdrop we found ourselves in.
Sorry, hit the wrong button there. What do you make of the stubborn mortgage rates above 7%? Because the CRE situation is getting dire, for lack of a better words. Double defaults was a new term for me this week. I had not aware that we had reached that stage where the financial media has recognized it. And now we start looking at residential real estate and the Fed stating emphatically that they are no longer they're going to continue to sell MBS and let it roll off. That's disturbing because at some point they've got to answer that duration question we talked about last week. What happens if we get stuck with a 7.5% 30-year mortgage over the longer term period? They can only have so many buy downs for so long in the new developments.
Yeah, I mean, and that is the issue. I mean, I don't see a scenario where this somehow improves unless like you start rolling out UBI or just like a complete, tax overhaul with some sort of new program that they've come out on that front. So they're just, I mean, look, if you want to just sort of dumb it down and think about it as simply as possible, home sales are just at lows for a reason. I mean, you have a demand problem and it's because of the price. So I just think this is going to be sort of a slow sort of slog down. And just in the way that, if you want to think about like OER, which is definitely lagging in terms of how that's calculated, it's certainly not reflective of all markets. You do have to consider the fact that, especially for a place like Nashville and elsewhere, it's going to have a much larger impact than it has like in really the last real cycle, and that is GFC. So, I mean, we have a couple of things happening in some of these markets, and this is not just like limited to Nashville. And that is, the price is the problem, right? But then people aren't relocating like they used to. So like things like net migration, they slow in rate hiking cycles. You can observe that across markets. And you have all the supply on top of a softening labor market. So look, somebody may think that like when I say that, that's somehow like a doomer statement or whatever, but we just need to move past that and just acknowledge that that is a real issue, and that's what's actually happening. And I've heard people say, hey, like, well, you can't believe like the labor data or this or that. I'm like, come on now. Like it's directionally right. Okay, so this is a problem. I don't know what it's going to look like moving forward, because there are so many hypotheticals, the government seems to step in very quickly these days. So you can't rule that out. But at this point, I mean, people in the real estate market, they basically put themselves out of a job because they've just pumped it for so long. And it's to the point where nobody can afford it. A place like Nashville, really city center, and I would say Austin is this way, Denver is this way. They're younger populations. They cannot afford things like rent or even, especially buying a home right now.
Tampa's this way also. And Tampa, Miami have fallen into a box where the base price for, that's not working. What the heck is going on? Are you there? Can you hear me? Here we go again.
I can hear you.
Okay, good. The microphone's not reflecting on my X app. It's Spaces is getting squirrely again. I apologize, everyone.
All good.
Yeah, good. Freaks me out whenever I see these lights change on here, and it just does that. Tampa and Miami have become unaffordable with a lack of starter homes, obviously. And now with the hurricane damage, the prices are going to stay high for a little bit longer as people go to seek a new place to live. And it gave the investors a chance to come out and rent at the price that they wanted to. What I'm concerned about, though, is 7% as a base rate for 30-year mortgages going to be tolerable for new home buyers? I don't see the affordability issue going down anytime soon, especially with the risk of an inflationary or stagflationary environment next year.
Hell no. Just no. I mean, and you can see this clearly in the data, and these are things that are observable at a local level over time. And, for a place like Nashville, the people, if you want to talk about growth in home ownership, you're seeing it in older age groups. And that only makes sense, right? I mean, if you think about, net worth across different age groups or generations, it's going to be obviously more biased to older people. They've had a longer time to obviously accumulate wealth, so they can come in and they don't necessarily have to pull a mortgage to buy a home, or maybe they're like, only financing a small portion of it. So, but in the aggregate, you need like broad-based participation across all age groups for the housing market to be healthy, especially on the home ownership side. So this whole thing is just, it's kind of a joke. I mean, it's just a very slow slog just down. And it'll sort itself out, barring anything like UBI or just some major tax overhaul happening, especially, in a place like Nashville City Center, Denver, obviously Austin, which have very similar characteristics. Home prices are going to come down, period. There's just way too much structural supply in these markets. And you're seeing that really, in a lot of Sunbelt markets, but those three markets in particular have a lot of commonalities. So
I'm going to ask a question just from your observations and your ear on the ground, because we're starting to hear rumblings down here about this. And it's an interesting problem. A deterioration in the credit quality of applicants for new homes and existing homes. Have you heard similar stories in your neck of the woods? We're hearing it because people are desperate. They're getting that 3%, 2%, 1% government FHFA program incentive to put low down payments on homes, but their overall credit is so poor they're having a hard time getting accepted for these loans. Are we to that point where only the lowest percentile are applying for new homes, whereas those who are capable of putting 20% down, selling a home, buying a new home, still having no issue? So that's not a high selling, high flip category for existing home sellers and buyers. But for the new entry level homes, if credit quality is deteriorating, I don't see your problem getting any better anytime soon.
Yeah, and that's exactly the issue. I mean, you could look at something like the HMDA data, which gets very granular in various markets in terms of originations and maybe why somebody got denied for a loan, and oftentimes it's exactly what you're referring to. I mean, if you want to just think about it simply across like all home buyer cohorts, whether it's like a first time home buyer or otherwise, people just simply can't afford it. And oftentimes it does come down to, at this point, we do have credit quality issues. So yeah, this is gonna sort itself out one way or the other. If I'm kind of back to, I guess, three markets I've really talked about: Denver, Austin, and Nashville. What I see as kind of like happening is you have a population that is younger in those three markets. So to your point, that would be kind of more first-time homebuyer scenario markets. But what you're also seeing is that they have all this building, all this new construction. And then if you start to like dig into the households and what they look like, there is a much higher concentration of younger households and smaller households. And when your population is younger, you have a higher labor force participation rate, employment population ratio, those types of things. So when you do look at the local labor market, it is representative of what, that household or person is experiencing. That to me is not a great scenario given the backdrop of a softening labor market, because that means theoretically there are fewer earners per household in that scenario. So if that one person loses their job, that's a problem. And if you want to think about like supply hitting the market, well, there you go. And I'm not just talking about on the renter side. It's definitely more biased to renters, but it also exists in higher concentrations on the home ownership side. So there's a lot of things to consider. And obviously what sits under all of that is just speculation. I mean, you have investors just oftentimes trading properties without ever, renting them out or what have you. So there's a lot of dynamics sort of at play under the surface.
One final question for you, Kenny, and this is definitely a local question. Then we're going to go to Three Aces next, then Mike Bergman. Kenny, this question is somewhat unique to your area, since I've been to Smyrna, Tennessee several times, and I know where Nissan's located in their big plants and headquarters and all of that. The layoffs and shutdowns being announced by Nissan, and also the reduction in Toyota and other auto manufacturers, the anticipated impact in your region, are these, have you heard about how long the layoffs will occur? Are they prolonged shutdowns, or are they permanent as some other automakers have adopted?
Yeah, I wish I knew more about that, John. Here's what I'll say. Yeah, I mean, Smyrna, south of town in Cool Springs, that's where Nissan North America is headquartered. And then they have, I know there's like a lot of production facilities like down in Spring Hill and that whole area. This gets back to just kind of a larger issue that a market like Nashville has, where we were once like considered a very kind of stable local economy. Because if you know anything about Nashville, we're like a healthcare like hub. Like we're kind of like the healthcare provider capital of the US. I mean, if you think about HCA, I mean, that's it all kind of started here, like the provider for-profit model. But then especially after GFC, we had like a lot of companies like, Nissan and others relocate here. So what I'm saying is that our local economy, and for other reasons too, is more cyclical than it used to be. That just poses an issue to a variety of things, and obviously that flows through to home prices.
That's what I was figuring. Kenny, thank you so much for the update. And folks, don't forget, Kenny does contribute to MacroEdge.net. You can read his work there. Kenny, have a great weekend, sir.
You too.
Thank you. Three Aces, how are you doing, sir?
Hey, my brother. I'm doing good, doing good. I was in, and then I had the problem again from the laptop. And then when I closed it out and came in here, and then when I closed it out, even though I'm in here, I can still hear it coming from the laptop. So Musk has got a little work to do there on this thing.
Hopefully it's part of his government efficiency programs. What you got for us, sir?
Hey, so, I just wanted to float something by you real quick. I'm in South America. I own mining and trucking companies and stuff. I'm an industrialist, right? I'm not trading the markets like for a living. Okay. I did that in the 90s, but, so I'm the guy buying the equipment from China. I'm doing it all every day and all that stuff. And, I've been looking at this scenario here, and I just wanted to float something by you. This, am I on track or am I on crack kind of thing, right? So, what I've experienced in the past 20 years living in the Africas and South Americas and Dubai's and all these places, being from California, is what the Chinese really did was they exported deflation to the entire world. That really was their product, man. And that's what they do. They come into these countries and just completely eviscerate everybody in price and grab the entire market share. And that's where the bridges and the roads and all that shit come in. And they're very good at it. And I'm just sitting here thinking Trump and these tariffs and got to build it here and, and how expensive everything is and all this other stuff. Just wondering, I mean, because, I talk to China 3 or 4 times a week. They are destroyed. I mean, my guys there are like ready to hang themselves. The business just stopped. Trucks and stuff, right? Trucks, dump trucks for gravel and shit like that, okay? And I'm just wondering, what if they come back here with a move? Because, they just did a stimulus and they can go back into that let's export deflation mode that they were in for a very long time until the COVID bullshit. I'm just wondering, 2 trillion has come out of the treasuries. They've rolled it off. 2 trillion and ish has come out of the reverse repos, right? It's not like that's nothing. I mean, that's $4.5 trillion, whatever. That's not quote unquote there. I'm wondering because they're going to do something. I mean, China's not just going to sit back there and go, oh, let this Trump, do whatever the hell he wants and talk all this shit and everything else. They're coming at us. And the only thing they really have is deflation. That's how they screw everybody up. So just wondering, you think I'm just wondering, like, what happens, right? I mean, let's just say Trump does this with Musk, and I hope to God he does, and slashes and burns and all the rest of it. And then, he's promising everybody prices are coming down. Well, prices have not gone down. They're still very high. They're just not going higher at the rate that they were. And that's the part I don't think people really understand. But let's just say he pulls it off. He gets prices down and he slashes, the deficit even by half. Forget about the 2 trillion. I'm looking at Germany. Germany's been in a recession for 2 years. The DAX is at an all-time high. Like nobody, hey, let's go, guys. I mean, am I going crazy here, or is there some very serious risk out there? Once this kind of stuff cookies starts to crumble on this stuff. Just wanted to see, am I on the right track here with some of this, or am I completely in left field on it? Thank you very much. And Kenny, I've been following you and Six. Great finds, John. Thank you for that. Great space. Thank you.
Thanks, Three. Well, I'll offer my opinion, and I'm going to bring Mike on to offer his too. First of all, I think that Trump, anything he does is limited, as there's only 21% of the total budget that they can play with, period. 79% of it is statutory spending, and it's tied and indexed to their own rate of inflation. It is almost impossible to cut that without making actual changes in Congress doing their job and writing new laws. Number two, I fear that they don't have the backing to make those changes. While importing deflation from China would be bad, if we created deflation by, let's say what Druckenmiller, a 5.5%, 6% 10-year, and a Fed funds rate increasing next year in the face of a stagflationary cycle, I just don't think the American people would tolerate it. And I don't think the Republican Party has the stomach for it either. That's why I fear we're going to get stuck into a stagflationary cycle. That's where I think the trap is lying. This talk about insourcing sounds great on paper, but when you put the actual numbers down and look at the cost benefits for it, it's extremely difficult. And if anyone thinks for one moment that the environmentalist wackos are going to let you build more plants and more facilities without opposing them, you're nuts. We've already had problems with it, the rebuilding down here. Fortunately, the governor overrode them and stopped the nonsense so people can rebuild their homes. We're going to see the same thing when it comes to moving an industrial plant cost-wise from China or Vietnam back to the United States. God bless Donald Trump on the theory, but the theory should be on re-incentivizing new businesses to start and new technology to start. The majority of our economy is service-based. You don't need infrastructure or factories to engage in the idea of insourcing. It's crazy. Look at the new media. It's X, period. End of conversation. X was ahead on the election. Joe Rogan was ahead on the podcast. AM talk radio was dying. All of the things that everybody held as traditional economic modeling is being shot to hell in a handbasket. Yet people don't want to hear that. They want to return to the good old days. That ship sailed, folks, and you have to modify the economy to meet the new demands. And that includes restructuring people's perceptions on what money costs. And Mike, welcome aboard. If you could please remind everybody, when money costs more, it's because of demand, not just government action, right, sir?
You're absolutely right. I'm a loan officer myself here in Southwest Florida. I manage the #1 office in the Southeast United States for my publicly traded mortgage company, and I can tell you right now that we've been, as loan officers in general, we've had a really difficult 2.5 years here, and part of it is due to the consistency of just increasing rates at a rapid fashion. Just in the last 45 days here, the average mortgage in my area, which is around $400,000, has increased by $200 and $250 a month. the number of people that can be on board with coming in and getting a pre-approval and having that dream of ownership of a home, and then over the course of the period of searching for that right home, increase their payment by $250. It's too much for them to bear. I have many clients that make solid money, that make over $100,000, that are just completely disenfranchised. And actually, the reason why my office is so successful is because of our Spanish loan officers, which are really the only ones that are actually buying homes. If you don't speak Spanish in Florida, at least in the south area of Florida, and we're in the southwest Florida, so we're not in Miami or anything like that. It's Fort Myers. You're just not doing business. So actually, a lot of my business is just assisting my top loan officers presently. And we've seen massive reductions. Right now, September was, in this area, $400,000 was the median price for the home, which was the lowest level since November of 2021. So we've gone far and past the 2022 days, the 2023 days, and we've come all the way back down to a level. Even though the nation as itself, it keeps on seeing these numbers that are getting published by the government, that they're higher and higher, we're definitely seeing that swing going in the opposite direction, and increasing the amount of actual homes that are for sale. It's really absolutely gone up here as far as inventory, and that's just because people can't afford it. And then when you take into play the difference between existing homes versus those that are new construction, and the reason we do a lot of new construction, that's also why we're doing well. Existing homes are going to find themselves in a worse and worse position here as we go forward with these higher rates in the 6 and 7s, because they don't have the money and they don't have the wherewithal to think, hey, I'm going to throw $15,000 or $25,000 at my buyer in order to buy their rate down. They're thinking about purchasing their next home, so that they're not thinking about throwing that money out there. Meanwhile, the builders, we work with a lot of smaller builders. The bigger builders have their own mortgage companies. So they're all throwing $15,000, $25,000, and they're lowering prices month after month. So, I mean, if we can't be able to maintain a price of a home at $310,000 to $380,000, which is the kind of the mainstay home in my area here, without dropping prices and tossing endless money at them, we know we've got a severe demand problem. And there's only so long that we can go on for this. And for 2.5 years, we've all kind of been treading water. Sooner or later, there's going to be a lot of realtors that aren't going to have jobs anymore, or at least not be able to handle it. There's going to be just a lack of overall idea that people can buy homes and have that dream of American home ownership. And so I'm truly worried at this point here. We really felt like the Fed cutting rates would be the beginning of the end of this. And it has become clear that that is not the case. And we are going to be in this position for longer. And that may break the back of the American consumer in housing.
I tend to agree with you, because you're seeing it in automotive loans already. And despite popular belief, the American consumer is not of the mindset that an $8.99 rate on a 48 or 72 month or whatever it is at this point in time, depending on the vehicle and the financing and their credit quality, is affordable in addition to a mortgage. When you start putting all of that together, are the credit quality issues starting to really hit your applications, your desk, like you were talking about, that badly?
Absolutely. We're seeing it. The amount of applications that are, like, for instance, FHA, we can see up to 56.99% of the back-end debt-to-income ratio that includes any debt payments there. So, let's just say someone is doing pretty well for themselves as a household. Let's just say they're making $10,000 a month there. We're going to take that, and we're going to be able to allocate pre-tax, their health insurance, car insurance, all of that. And we're going to say that you can spend $5,699 for a house. I mean, that's not real. So people are coming to us with decent incomes, and they're trying to pay $3,500 a month or less, and that really doesn't get you very far. It's maybe a $450,000 home at most, depending on whether or not it's an HOA in this area, at least. And with taxes and insurance continuing to increase here with those levels, it's really become to the point where people are much more comfortable with going with a rental and abstaining from purchasing a home for longer, just because they just don't know whether or not they can handle those payments for long, and would be more comfortable being able to say, all right, after 1 year, I'm done with this. I can move on to some other place at a different payment.
Are you hearing more people trying to get into assumables?
Well, assumables is a big thing that a lot of people don't realize is actually the banks make assumptions for mortgages incredibly difficult. Banks do not want to do this. They don't make any money for having a loan assumed. So if we remember back into the early 2010s, when you had the Home Affordable Refinance Program, the HARP program, and the Home Affordable Modification Program, the HAMP program, if you had called in, you got some double-digit IQ person who didn't care and had 150 files assigned to them that had no incentive to get it done. That was the bad route. That is basically the one that is going to be servicing your assumption file. So I've had a number of clients that have had homes that they have tried to sell based on an assumption, which assumptions pretty much is only government mortgages, can't be doing on a conventional mortgage. And what happens is we get into a contract with another home while they're waiting for their assumption to be completed. And after 60 days, we lost your paperwork. Oh, we're going to need another 90 days. These are the kind of things that are happening there. And it's really completely understandable from a market perspective. Why would you do those and not make a single dollar by allowing this assumption to continue on a depreciating asset? Because, if rates are today at this level here, that servicing rights is not worth very much at a 2.75%. So they put those double-digit IQ people in front of those things, and they don't get done very fast. Sometimes it takes 6 months and 8 months, and it's kind of a unsaid attrition thing that, hey, if you're gonna have a lot of time in your hands, we'll get it done eventually. But they really don't want you to do that. They want you to pay up that mortgage and get a new one.
I bet you once we start seeing more 90-day DQs, they're going to really start looking at that a little bit differently.
Well, that's the thing, is that they don't really get 90-day DQs very often, and that's because the banks have learned that forbearances are very positive for their bottom line. If they can just let someone take 90 days and get themselves righted in their situation, and they can allow them to come back and make their payments and realize that letting this mortgage is not a good idea, go away, they can let the forbearance sit. And they learned in the 2010s that if they let a lot of homes go in foreclosure, everything plummets and everything goes to hell. So the forbearances they do without question, and that allows people to usually get on their right feet by 3 months have gone by, at least for that matter. And so a lot of the actual delinquencies are either A, people who are too clueless to figure out that they can do a forbearance and request one, or B, their investment properties and they don't qualify for that sort of thing.
Okay, I'm going to ask you one quick question, because you're in this industry and you've seen a lot of the questions that are going around. It is something that we've been discussing internally in the MacroEdge circle. What do you make of the amount of quote unquote mortgage fraud that's been engaged in, where first notes were created claiming that they were going to live in a residence, and it turned out to be an Airbnb or short-term rental property? Is that going to come back and bite the industry here in the next this current downturn or upcoming downturn?
So we see a lot of that here in especially in Southwest Florida here, because we are in proximity very close to Miami. And a lot of people don't understand that there are actual programs that you can actually buy a house for a relative. and do it under the reference of a primary residence. You can purchase a home for your mother and qualify for it as a primary residence in a perfectly acceptable and above grade situation. But if you have a low talent loan officer that doesn't know these programs, they go in there, they try to lie about things. And we see right through that, at least in this office, because we've seen so much of it. But there's a lot. If you don't have a really good reason for buying a home in that situation, I could definitely see a problem in the future, because I've seen a lot of people who come in, they buy a house, let's say in 2022, and then they buy another house in 2023 as a primary residence, and then they're coming back to buy another home in 2024. And I'm looking at these rates that are sitting at 6-7% rates. And then of course they go to their Miami tax preparer who doesn't know what doing taxes means. And then they do a really poor job at doing the taxes and claiming no income or huge losses. And then if they want to come back and refinance those loans when rates do come down, they're not going to be able to do that. And if those rental rates, which we're seeing rental rates go down because really people aren't buying homes and people are not able to afford a lot in general because of those car payments you mentioned, rental rates have to come down. And as a result, I can't imagine they're getting the hefty payments they were receiving from Airbnbs and so on. They're going from Airbnbs to 12-month contracts, which of course, are going to be a lot less on a monthly basis just to cover their rentals. I don't see a lot of these people actually making money. And I'm wondering whether or not it's because they're housing, a lot of maybe illegals in there. I don't know. But it's very questionable, and I can't see it working out good in the future here. I do think that those that are buying multiple homes expecting hefty rents are probably misguided and looking for bad situations in the future.
Well, we're in the same neighborhood, so I've got one final question for you, because I'm in Southwest Florida also. So let's cycle back to what I was talking about with Druckenmiller and Bianco, talking about a 5%, 5.5% 10-year next year, and I'm still thinking that 5% is doable in January. That's an 8% plus 30-year mortgage. To your industry, is that not the big napalm bomb of napalm bombs right in your lap, heading into a slowdown?
It's devastating. We would be in really bad shape if it got anywhere close to that. We've been able to tread water only because of new construction paying for these mortgage rate buy downs. So, I mean, the reason my office is so successful is because we're very good with Spanish speakers. We're very good with the new construction, and they are paying hand over fist, $15,000, $25,000 per contract on even everyman homes, even at $310,000 even. They are bringing all that money, which is then being used toward buying the rates down. If we suddenly see, another 70 basis points on the 10-year to go back to 8.25%, I'm going to be delivering food to you via, Uber Eats or something like that, because we already don't have a very large demand issue, or we have a very bad demand issue right now. And if we saw rates rise to that level again and saw the 8 to 9% rates, there would be only one game in town, and that would be the large builders and medium-sized builders that are able to bring a lot of money to a table. We do forward commitments with builders. They're able to put large blocks of money where they're able to buy it in advance, and that's why you see the Lennars at like 3.99% still. It's because they bought it well in advance. If we saw a lot larger levels, you can see in the earnings reports for Lennar and D.R. Horton that they're putting like 15% of their overall income toward that. It's pretty excessive, and it's only going to continue that respect. And you're going to have less people buy homes that have homes already, because they're going to drop the prices on their homes they're selling, and they're going to get a lot and less out of it. And it's going to push prices down in general, and there's going to be a lot of problems. I can't see how that's going to go well.
Mike, thank you so much for your input and your commentary, because I value the people who are in the industry in the trenches every day, and it makes a difference when you talk to them. When you talk to the car dealerships, they're starting to freak out. And when you start seeing 10-year notes on $80,000 cars for $1,500 a month, you have to question how they're even able to remotely sniff putting a down payment on a home. Thank you, sir,
Well,
for
here's
doing
the
the
thing
show.
that
Oh, go ahead.
I just have one thing to add. It's not necessarily about the being rates, having rates that are high. It's about the week after week change. When it becomes extremely volatile, like for instance, since the Fed rate decision there on the 18th, we hit 3.599 on 10-year, and then we just went up to 4.48 just this week here. That's only 45 days. If someone came to me and wanted a pre-approval, and I told them we were going to get them a 5.99% rate on that date, and that they were able to buy a home, they were going to ask me how much did I qualify for. This is not, they don't understand this. They don't understand that there's changes out there. They think everything is just like buying something at the store. So they don't realize that every single day a massive market out there is changing rapidly, and one data point at 8:30 a.m. can change everything. They think, all right, well, Mike just told me I could get this, so I can get this. And then when 3 weeks go by, they come back to me with a property that is in their price range, and I tell them that their payment is up $250. They think either A, I'm an asshole, or B, they're like, this is ridiculous. I don't even want to buy a house anymore. That is what is demoralizing to the first-time home buyer specifically, and it takes a lot out of their everyday appeal toward buying a home. If we have stability where rates are the same for a bit, we can digest it. We can digest higher rates in those situations. We just can't deal with it every week. Rates are going up. That's where it's really truly the worst environment for buyers.
Thanks, Mike. And that's true, because you hit the nail on the head. And that's why cancellation rates are something you will not hear advertised at the National Association of Realtor website. You got to dig for it. And that's why when you go to macroedge.net, we have the RE Insights team writing about this. It's another new service that we're offering at MacroEdge. We can sit there and provide background data, specific sector analysis, that with Ozone, which is more of a macro based, and of course the Visions Fund. Gang, we offered all. MacroEdge.net. Check out the offerings. Highly recommended and complimented by Charles Payne on Fox Business. Hey, we're going to get that cheap plug-in every time somebody on national television mentions us. Sorry, not sorry. For MacroEdge Radio, this is John Galt speaking. We will announce our special guest next week and the week after, because we have a very special interview for Black Friday, which will be in podcast format. For MacroEdge, good night now.